JD.com's Q3 2025 earnings are out, and it's the ultimate corporate paradox.
It really is.
You've got soaring revenue, a huge surge in users, but then this sharp collapse in official profit.
A total collapse.
So today we're diving deep to figure out how the core business can be shining so brightly while the overall bottom line is, well, drowning in red ink.
It's an intentional high-stakes gamble, and you can see that tension perfectly in the numbers.
Okay, so let's jump right into the results and the forward guidance, because the market had pretty low expectations, and JD just blew them away.
Completely.
Total net revenue for Q3 came in at RMB 299.1 billion. It's about $42 billion US dollars.
A solid 14.9% increase year on year. That really topped what the consensus was looking for.
Yeah, estimates were around 294 billion, so they nailed the top line.
And critically, they smashed the adjusted profitability figures. And, that's what analysts often look at to gauge the health of the ongoing business.
Whatever core operation.
Exactly. The non-GAAP diluted net income per ADS, that's the adjusted earnings per share, it came in at RMB 3.73.
Or 52 cents in US dollars.
And the street was only expecting around 2.79. So this was a massive beat. It shows some powerful core efficiency.
Okay, that all sounds stellar. So if they're beating on revenue and on adjusted profit, where does the collapse come from? This is where we get to that big, painful asterisk on a report.
This is the GAAP net income.
The official profit.
The official profit attributable to shareholders. And this is where the cost of their whole strategy just shows up.
And it showed up in a big way.
It fell from RMB 11.7 billion this time last year in Q3 2024 all the way down to just 5.3 billion this quarter.
Wow. That drop is what led to the company reporting a consolidated operating loss, right?
Right. It flipped their operating margin from a pretty healthy positive 4.6% a year ago to a negative 0.4% this quarter.
That kind of swing from positive to negative margin must have spooked a lot of investors. I imagine management had a pretty clear answer for that.
They were completely unambiguous, and this is really the core of our deep dive today. They explicitly said the decline was due to increased strategic investment in new business initiatives.
So they're basically saying, we did this on purpose.
Exactly. They are intentionally spending short-term profit to try and capture long-term market share.
So if you're looking at this report, the huge gap between the great adjusted earnings and the collapsed GAAP earnings.
Right.
It isn't the core retail business failing.
Not at all. It's because a huge chunk of capital is being funneled into these new loss-making ventures. The adjusted numbers strip those out.
So management is basically showing you their forward guidance through their P&L statement.
That's a great way to put it. They're telling you they're prioritizing market presence over immediate profit.
Let's get into that strong core then, JD Retail. This is the engine. It posted net revenues of about 250.6 billion RMB.
Which is 11.4% growth. Still very strong.
And what's fascinating here is that even with all this spending everywhere else, JD Retail's operating margin actually expanded. It went from 5.2% last year to 5.9% this quarter.
That margin expansion is huge. It points to excellent cost control, efficiency, and fulfillment. But there is a catch.
Of course.
The traditional backbone of JD Retail, electronics, and home appliances is slowing down. Revenue growth there was only 4.9% in Q3.
And that's not really a sign of failure, is it? It's more of a comparison problem.
Precisely. The CEO, Sandy Shude, called it an industry-wide challenge, and it's because of what we call the high base effect.
Meaning last year's numbers were artificially high.
Exactly. You're measuring against a quarter last year where demand was just juiced by these big government-backed trade-in policies.
Yeah.
So the comparison is really tough. The baseline was just extraordinarily high.
Okay, so if the high-value hardware stuff is slowing, where's that overall 11.4% growth coming from? They have to be diversified.
They are, and this is probably the biggest sign of strategic success in the quarter. The shift is happening in two places. First, general merchandise revenue just accelerated, jumping 18.8% year on year.
And that's the strongest it's been in a while.
Since Q2 of 2023. This is essential because general merchandise, it drives more frequent purchases.
And the second area?
Net service revenues. This is our high-margin stuff, logistics, marketplace services, marketing. That whole segment grew robustly.
Robustly.
30.8% year on year. It's a massive shift. Within that, marketplace and marketing revenues grew 23.7%, and that has accelerated for, get this, 7 straight quarters.
7 quarters in a row.
7. Advertising revenues alone were up over 20%. They're getting much, much better at monetizing that huge user base with services, which is a much better long-term business than just selling low-margin electronics.
So let's talk about the source of that gap loss, the new businesses segment.
The money pit, for now.
Right. I mean, spectacular revenue growth, up 213.7%, but it came with a non-GAAP operating loss of RMB 15.7 billion. That's where all the red ink is.
And that 15.7 billion is the sticker price for attacking new markets, mostly things like JD food delivery.
Which is just a fiercely competitive space. You have Meituan, Alibaba's Taobao, Shanggu.
Absolute giants with massive first-mover advantages. It's a brutal fight.
So with that level of investment, management must be pointing to some sign of progress. They offered some forward guidance on this, didn't they?
They did. They highlighted that the food delivery business actually narrowed its operating loss sequentially in Q3.
Sequentially, so quarter over quarter, not year over year.
Correct. And they said it's because of improved unit economics and financial discipline. Now, you could say that's management spin.
It does sound like it.
Yeah.
Is a slightly smaller loss on a 15 billion loss really a sign of discipline?
Well, that sequential narrowing is their main defense. Unit economics just means, is a single order profitable? Is the money from one delivery starting to cover the cost of that specific delivery? If that's improving, it means the massive fixed costs are starting to spread out over more efficient orders.
So they see a light at the end of the tunnel. But analysts? They seem pretty skeptical.
The views are totally polarized. Morgan Stanley actually downgraded the stock because of this. They cited the incessant investment in new businesses and said it's set to significantly slow JD's revenue growth and structurally erode its margins.
Structurally erode margins. That's a really strong warning.
It is. It's basically saying this spending might never stop, especially against rivals who already own the space.
So some are saying they should just stop.
Yeah, one analyst literally suggested that cutting back on food delivery would be a smart move because JD is not going to win either way. The feeling is they have to prove this spending leads to more sales on their main retail site. Otherwise, it's just burning cash.
What about international expansion? Are they burning cash there too?
They're definitely expanding Joybuy in Europe, JD Mel's in Hong Kong for 2026, but management was very quick to say that investment will not be substantial.
So they're keeping that on a tight leash.
It seems so. They're promising prudent financial discipline abroad. The big cash burn is all focused on the domestic market right now.
Okay, let's step away from the profit debate for a second and talk about user momentum, because that's the whole justification for the strategy.
And this is where the story looks completely unstoppable.
Annual active customers surpassed a new milestone in October. 700 million. I mean, that is just staggering scale.
It's crucial scale, but more importantly, they're changing how those people behave. User shopping frequency is up over 40% year on year.
For 2 quarters in a row.
2 quarters in a row, and across all users, new, existing, and their premium JD Plus members.
And there's the connection. The huge losses in food delivery are almost certainly what's driving that 40% jump in frequency.
Exactly. The loss in new businesses is the price of admission for this kind of user engagement. If you get someone to order food twice a week on the JD app, they're much more likely to remember to buy toothpaste or a new charging cable there too.
They're paying for stickiness, trading gap profit for long-term customer relationship value.
And that momentum carried right into Q4 with Singles Day.
Right. They set a new sales record. They cited a nearly 60% jump in order volume and a 40% increase in the number of shoppers. So that engagement is definitely real.
And it's not just food. They're diversifying into other high-growth areas. JD Health, for example, is signing deals with pharma giants like Eli Lilly and Bayer China. They're becoming a major online platform for new medicine launches.
And what about the infrastructure side? JD Logistics must be critical to all this.
It is. It supports the core retail margin expansion. They're building out internationally to a new warehouse in Dubai, a new air route from Shenzhen to Singapore, expanding that Asia-Pacific network.
And finally, AI. Everyone's talking about AI. How are they using it?
Mainly for efficiency and customer service, to handle this massive scale. They launched an AI digital assistant app, and get this, they said their 247 AI customer service handled over 4.2 billion inquiries during the big 11.11 sale.
4.2 billion.
That's the number. And handling that volume with AI is how they plan to keep those core retail margins expanding, even as everything else explodes.
So if you had to boil it down, what's the aha moment here?
The aha moment is that JD is successfully shifting its revenue to high-growth, high-margin areas like advertising and services, and they're growing their user base like crazy. But The decision to take a 15.7 billion RMB loss to do it is the defining bet.
Okay, so let's unpack this for you, the listener. You're watching a company that is making its core business more efficient while at the same time aggressively attacking these super competitive markets.
The core business is basically funding a war for consumer time and attention.
That's it. That's the whole thing. So the entire investment thesis really rests on one question.
Can they make it work?
Right. Can that sequential loss reduction and those improving unit economics they talked about in food delivery continue until the business can actually sustain itself? Or is it just a long-term necessary cost to keep people coming back to the app, to juice engagement across all 700 million users?
That's the critical trade-off.
Sacrificing profitability today for platform stickiness tomorrow. And that is what you should be monitoring moving forward.